Nonprofit organizations play a crucial role in our society, but are they public or private entities? The answer isn't straightforward and depends on how each organization is structured and funded. According to IRS classifications, all 501c and 3 nonprofit organizations fall into one of two categories: public charities or private foundations. This distinction affects everything from tax treatment to operational requirements. When determining whether a nonprofit is public or private, the IRS evaluates the organization's funding structure and operational model. All 501c3 nonprofits are initially presumed to be private foundations unless they can demonstrate qualification as a public charity, typically through a mathematical public support test. Private foundations are nonprofit organizations that typically receive funding from a limited number of sources, such as corporations, families, or single individuals. The money is often held and controlled by directors or trustees, and these organizations tend to rely on investment funds to finance their activities. Private foundations come in several types. Operating foundations actively conduct their own charitable programs, like running a museum or research center. Non-operating foundations primarily distribute grants to other charitable organizations. Corporate foundations are created and funded by businesses, but remain legally separate entities. Family foundations are funded and governed by family members, often spanning multiple generations. In contrast, public charities receive their funding from a broader base of sources, including individual donations, government grants, and support from private foundations. Common examples of public charities include hospitals, schools, churches, homeless shelters, and universities. To qualify as a public charity, an organization must meet requirements outlined in Internal Revenue Code Section 509A. Public charities typically provide services directly to beneficiaries, though some serve supportive roles to other public charities. Public charities must demonstrate significant community involvement in both funding and governance. This often includes having a diversified board of directors, transparent reporting of activities and finances, and maintaining a broad donor base to meet the IRS public support test. The operational differences between these two types of nonprofits create important legal distinctions. Private foundations must pay an excise tax on net investment income, are prohibited from engaging in self-dealing transactions, and must distribute at least 5% of their assets annually. They also face penalties for failing to comply with specific IRS rules. Public charities, on the other hand, can engage more freely in fundraising, face fewer limitations on investments and grants, and are permitted limited lobbying activities within IRS guidelines. Tax deduction rules also differ significantly for donors. Those who contribute to public charities can deduct up to 60% of their adjusted gross income for cash donations. Appreciated property contributions are deductible at fair market value, up to 30% of adjusted gross income. For private foundations, deductions are limited to 30% of adjusted gross income for cash and 20% for appreciated assets. Only cost basis is deductible for certain asset types, such as closely held stock. When choosing between establishing a public charity or private foundation, founders must consider several strategic factors. Private foundations offer greater control over operations, but with more scrutiny and restrictions. Public charities require continuous public support, whereas foundations can operate on large initial endowments. Public charities are more service-oriented, while foundations are better suited to strategic grant-making. Private foundations may better serve families or corporations seeking to create a legacy institution. Both public and private nonprofit organizations contribute significantly to economic and social well-being, offering benefits that private sector businesses often cannot provide. This is why the Internal Revenue Code allows most nonprofit organizations to be exempt from federal taxes. Understanding the distinction between public charities and private foundations is crucial for compliance, tax planning, and long-term sustainability. The rules governing these classifications can be complex, and failure to follow them could result in fines and penalties. Consulting with an experienced nonprofit attorney can help ensure proper classification and operation of your nonprofit organization.